Vladimir Putin recognizes the independence of two regions, moves forces in and setting the stage for an invasion. What does that mean to the markets and your money? That's up on 3 minutes on Markets and Money. Yesterday, we saw Vladimir Putin recognize the two separatist regions in the Ukraine. Of course, this sparked a lot of concern. Futures down over 500 points late last night. This morning, though, futures recovering rather sharply. This is important because as the markets are trying to look through what's happening with the geopolitical risk in Russia, of course, we also have the Federal Reserve coming up in March. What does this mean for the markets? Now, importantly, markets have been holding support here and are going to try to do this again today at these October lows. This is important because the markets have already violated important support, which was this running 20-week moving average that has run along the bottoms of this entire rally starting from the March 2020 lows. This violation of this support line of these previous lows will certainly set in a move lower in the markets, probably to around 3,800 on the index. Don't dismiss the risk of a bigger decline, as we already have a fairly defined head and shoulders pattern now formed in the markets. The neckline is currently sitting at these October lows. Technically, a break of that neckline should retrace 50% of the previous rally, which would bring us back to this pre-pandemic peak that we saw in February of 2020. So again, downside risk is somewhat substantial. Now, the question becomes, of course, where in here does the Fed begin to take actions in terms of reversing monetary policy, moving back into more QE, trying to bail out markets? Our suspicion is, and this is also our article on the website today at realinvestmentadvice.com, where and what is the Fed put? Our suspicion is that as soon as we break this neckline around 4,000 on the index, we're going to start seeing the Fed become much more concerned and start talking about geopolitical event risk, talk about economic risk, talk about potential for recession, reasons to start slowing the aggressive nature of their rate hikes. The problem for the Fed, of course, is being trapped at zero now with interest rates, leaves them very little monetary policy room to offset the risk of a recession should one occur later this year. I'm your host, Lance Roberts, for 3 minutes on Markets and Money. We'll see you tomorrow.